Hello, hello.
Hello.
Hi guys.
A lot of
Hi.
excitement going on.
A lot of excitement going on. So I just want to mention a poll. The poll is, do you do your financial statements internally or do you use an external accountant? 36% of our respondents said they do it internally and 64% say they use an external accountant.
Rochelle, I want to comment on that actually, because even when you use an external accountant, and one can say that obviously it's a good thing, you should not delegate all the thinking. You should understand what it is that they're giving you. It is your business. It is not the accountant's business. And therefore, even if they're doing the books, do not abrogate your own responsibility to your own business. Especially if you're paying an accountant, let him teach you how to look at your financial statements. In fact, what I always tell the small businesses, let the accountant do it. Let the accountant show you how to create your books for 1 month and actually do the job of creating your books even once. Because that is the only way in which you're going to get into the detail to understand that when you can read it. And when you make errors, let him show you what to do to fix it. You must understand the guts of your business. So just to summarize again, because we've heard a lot, the income statement is about, am I making money? Your revenue should exceed your expenses, which gives you a profit, right? That's the goal. The bigger the profit, the better off you are. Paul talked about two different margins. There's the gross profit, which is when your revenue exceeds your variable cost. In the way Mark talked about it, right? That's when your coconut sales exceed the cost of buying the coconut. That's the gross revenue. Your sales exceed your variable costs. Then the net profit before interest and taxes, right, is when you minus your gross profit, the additional expenses in your business, and that should also be profitable, right? But that's when your revenue and your profit exceeds your fixed costs. Yes. And therefore, you know that you're in a healthy situation. Now, I've been in situations where I've seen businesses, one quite recently, where they have a very healthy gross profit and then a huge fall off in the net profit. That means the senior management is too expensive because they have overly done too much in terms of the fixed costs, because the gross base of the business is fine. So these are some of the things that you'd want to look at. Again, revenue exceeding expenses gives you profit. Revenue exceeding variable expenses gives you your gross profit, and the gross profit minus your fixed expenses gives you the net profit, right? Just to be clear. The balance sheet is about your net worth. What do I own minus what do I owe? Which basically then says is what I would have when everything's gone and left over. What's left for me? That's the balance sheet. And it's always a snapshot, meaning it's what is it now, 2 weeks from now, a year from now, whatever it is, you track that balance sheet. And third, Mark talked about this, the cash flow statement. The bank is a very good place to understand that, right? How much cash is coming in and how much cash is going out and how much cash do I have left? You ever see anybody go to the ATM and praying? When you are praying at the ATM, it means you do not have a cash flow view in your mind, because you should have known my salary went in, my grocery bill went out, my JPS bill went out, and this is what I have left over. If you are praying when you go to the ATM, you do not have a cash flow view of your life. How much cash comes in, how much cash comes out, and what do I have left over? Very, very critical that we understand these three statements: income statement, balance sheet, cash flow statement.
Okay, so Nevada, in giving that summary, I just want to open up some questions now to our viewers. I saw a question earlier in regard to Adrian Rudd actually asked, what are the top 3 indicators you would use to assess business health from the financial statements in this COVID period?
Paul, you want to tackle that?
Yes, basically, I would look at the gross profit margin. The reason why I look at the gross profit margin is because the fact that I want to find out how efficient I am in terms of my pricing and how efficient I am in terms of sourcing my cost of goods sold. Yes, I want to be very, very efficient in those. I've looked also look at my receivables. How long is it taking me to collect from my customers? If it is a case that my credit policy is 30 days and I've got over 50% of my receivables over 90 days, I'm beginning to get a bit worried, because the longer the receivables take to be collected, the higher the probability that I will not collect it. I'll also like to look at the payable days. How long am I taking to pay my suppliers? If I'm taking a very long time to pay my suppliers might say, hello, sunshine, cash on delivery. So basically, the cycle is I cannot collect from my customers, I cannot pay my suppliers, and now he's asking for cash and delivery. And the next ratio I'd look at is what is called the gearing ratio, leverage. What proportion of my capital is debt capital? Yes, the reason why this is important to me is because the fact that if there is a downturn in the economy, I've got to be still paying interest on my loans. And I've got to be able to generate sufficient revenues, cash, earnings, call it what you may, to be able to pay the lenders of loans. Yes, so those are the three that I would looking at very closely, because there are lots of risks, and this COVID-19 has highlighted considerable amount of risk that companies did not think of. And the whole environment is going to change. A lot of companies that looked very attractive a few months ago to invest in, they don't look so attractive now.
Thanks for that, Paul.
And just to build on that real quick, Rochelle, so in terms of those ratios that Paul just spoke about, if you think about it, particularly in COVID times, right? So you think about your gross profit. Your gross profit is what you have left after you've paid for all of the inputs in whatever you're selling to build your business, right? So typically whenever the economy is going through stress, the first thing that people tend to do is offer discounts, right? So when they cut prices and they offer discounts, then your gross profit margins get squeezed. So if you're looking at a company that you want to invest, or you're thinking about it from yourself, particularly in the space of COVID, your gross profit margin will tell you how much discount can you afford. And some people, well, if they don't really understand how much discount they may cut too deep, right? Or sometimes you need to cut too deep so that you can get rid of the inventory, right? So and then the discount,
informed decision.
Exactly, right? So if you give a deep discount, that may allow you to go through your inventory a lot quicker, which allows you to convert into cash a lot quicker, because you need the cash so you can pay your interest, on your payments, so you don't default, right? So I absolutely agree with Paul, and again, gross profit margins, your overall structure of everything, and then also obviously your balance sheet and how much data you're paying and so on.
Okay, thanks for that, both Paul and Mark. Paul, there's actually a question here for you too. Can Paul discuss how a person could adjust their capital structure to reduce cost of capital by focusing on NPBIT?
NPBIT, net profit before interest and tax. Basically, if you've got significant amount of debt in your capital structure, then you could go to your banks and said, Mr. Banker, I'm facing some challenges here. I'd like to restructure my debt so that it doesn't significantly impact my business. Mr. Banker will enter into some negotiation and discussions with you, because in the long run, Mr. Banker's loan is at risk. And he may want to, rather than say, come in and wind up your business, he might want to work with you to ensure that your business continue in the long run. So therefore, you could restructure your debt if you've got considerable amount of debt in the capital structure.
And another aspect to that, to Rochelle, is if let's say you took on debt 5 years ago, and this is particularly apropos for Jamaican businesses, where we're coming from a very high interest rate environment, right? So if you took on debt 5 or 10 years ago and the interest rate was 20%, 25%, well, now interest rates are much, much lower. you can either go back to your bank or go to another bank and refinance your debt, right? So you can basically take out the exact same amount of debt that you currently have at, let's say 10. And just by doing that alone, that will increase your net profit, your NPBIT, right? Because you decrease your overall interest burden.
Of course.